There are many types of loans you can get to fund your business. Each type has purposes that are best for it. I'll explain these loans and how they work. I was in banking long enough to know that credit cards, including personal credit cards, are a popular source of business financing. They're an easy source of financing when someone is hungry for money to fund their business dream. When owners sign up for and use multiple cards, it can seriously hurt their credit score, though. If cash gets a little tight and they start missing payments, even bigger damage is inflicted on their credit score. Ironically, this could prevent them from getting other sources of capital that would be more appropriate for their business. Credit cards have very high interest rates and fees, especially when a payment is missed. This is easily one of the most expensive loans you can get. Another popular reason owners and employees like to use their personal credit cards for business expenses is so they can earn miles or points. A company's accounts payable or accounting department has to balance an owner or an employee's desire for credit card rewards with using company cards that give the business more control, reporting, and efficiency. Business credit cards may be tougher to get than personal credit cards for new businesses. However, business credit cards are a convenient way for companies to make purchases, especially by multiple employees. It may be better to look to them more for their usefulness as a payment method rather than their appropriateness as a cash flow tool. Business lines of credit are excellent business loan choices for short term cash flow needs. You usually pay an annual commitment fee based on the commitment amount of the loan. For example, if your commitment amount is $100,000 and you are charged a 1% commitment fee, you would owe $1,000 for the ability to use the line, which may be advanced from the line. Your commitment amount is the maximum amount that can be borrowed at any one time. Interest is paid monthly based on the sum of the previous month's daily principal times the daily interest rate. The principal amount is the outstanding balance of the loan. Lines of credit usually have a floating rate, often with prime as the index. Floating rate means the rate can change on a frequent basis, for example, on a daily or monthly basis. Your rate is usually a rate used in finance markets like the prime rate, plus or minus an amount to arrive at your total interest rate. It may be collateralized by inventory or receivables. Companies that are stronger financially can get unsecured lines because of the strength of their cash flow. Collateral is company or personal assets that are pledged to the bank in exchange for a loan. I mentioned earlier that the commitment amount of the loan is the maximum amount you can have an outstanding principal balance at any point in time. The available balance is the commitment amount less any outstanding principal balance. When you borrow from the line, it's called taking an advance or a draw on the line. For example, if you took an advance of $1,000, the principal balance of the line would go up $1,000, and that amount would be credited to your deposit account at the bank. Operationally, you do this as a transfer from your line to your deposit account via the bank's online banking system. You make payments on the line by transferring money from your checking account to the line. It's very easy. Business lines are revolving lines of credit. You can take multiple advances and make multiple payments. Your commitment amount always stays the same, but the available balance decreases with each advance and rises with each payment. Let's say your commitment amount is $100,000. That's also your available balance until you take an advance. If you take an advance of $1,000, your principal balance is $1,000, your available balance is $99,000, and your commitment amount is still the $100,000. If you then make a payment of the $1,000, your principal balance is zero and your available balance goes back up to $100,000. One way lenders ensure that the line is used for short term needs is by requiring that you periodically rest the line. Resting the line means paying the principal balance down to zero. How frequently you must do this and how long the principal balance must stay at zero before you can take advances against it is detailed in your loan agreement. Lines of credit are for short term working capital needs like inventory, payables, or payroll. I know the head of a small company that received monthly financial statements that always showed decent cash balances. He went to write a check in the middle of the month and there was no cash. The bulk of his revenues were received near the end of the month. His month end cash balances were fine, but he didn't realize how tight cash was mid month. He got a line of credit to fix that. Lines are also used for longer seasonal needs. I mentioned earlier that I worked at a community bank that served many farmers. They would draw on their operating lines of credit during the growing season and pay the lines off after harvest. Lines are renewed annually. The lender will check on the financial health of the borrower during the renewal. The borrower will need to submit updated financial statements or tax returns to the bank. One clause in loan agreements to look for that's common in lines of credit is the due upon demand clause. This clause allows the lender to call the loan at any point. Calling the loan means the lender can demand that the full outstanding balance needs to be paid immediately. This may happen if the borrower's financial situation is worsening. It may also occur when the lender is weak. It's used very, very rarely, but you want to be aware of it during times of extreme stress in the economy and the financial system. In the movie It's a Wonderful Life, George Bailey is about to leave on his honeymoon when Ernie, the taxi driver, points out that there is a run on the building and loan that Bailey runs. The panic was sparked when a bank the building and loan worked with called their loan. The building and loan gave all the cash they had to the bank and closed their doors in panic. George calms the mob and saves the building and loan until his uncle almost ruins it again. A fun factoid: Bert and Ernie from Sesame Street were named for Bert the cop and Ernie the taxi driver I mentioned from that movie. Situations like that were more common during the Great Depression than during the Great Recession. What did happen during the Great Recession was that banks reduced the commitment amounts of loans, especially if the borrower never borrowed the maximum commitment amounts. That improved the bank's regulatory capital ratios. There's a joke that a banker is someone who's willing to lend their umbrella when it's sunny, but ask for it back when it starts to rain. The due upon demand clause and reduced commitment amounts are the realities behind that joke. A term loan is a loan where principal and interest are paid on a scheduled basis over the term of the loan, as opposed to lines where principal is drawn and paid back whenever the borrower wants. Equipment loans are term loans with amortization terms of 3 to 10 years and no balloon term. Equipment loans are usually fixed rate with consistent payments. Payments on term loans are often called P&I payments because they're a mix of principal and interest payments. They're collateralized by the equipment that's being purchased with the loan funds. Commercial real estate loans, called CRE loans for short, may be fixed or variable rate. They can have different repricing, balloon, and amortization terms. For complete understanding of these terms, watch my Basics of Business Loans course. They are collateralized by commercial real estate. Whereas equipment loans are usually extended when buying equipment, you can get a CRE loan when buying real estate, improving real estate, or when you just want longer term loans and have equity in your commercial real estate to borrow from. It's common for businesses to have more than one loan collateralized by the same property. Another thing that can happen is for two pieces of property to be collateralized by the same loan. This is called cross collateralization. Selling one of those properties but not the other while paying off the loan will require the approval of the lender. You can get all the loan types we're discussing in this borrowing section from banks and credit unions. You may want to investigate loans from insurance companies if you're borrowing more than a few $1,000,000 for CRE. When I worked in banking, insurance companies had very competitive rates, especially for fixed rate loans with long terms. You may take out a construction loan if you're building or improving real estate. Construction loans have a term of 1 to 2 years. They are usually floating rate. Monthly draws or advances are made on the loan to pay the builder based on how much construction's been completed since the last payment. At the end of the construction period, the construction loan is converted or refinanced into a commercial real estate loan discussed in the previous slide. The line between personal finances and business finances is very thin for small businesses. Owners may prefer to use personal loans rather than business loans to get funding for the company. It may be easier for them to qualify for a personal loan than to get a loan for their business. Some options include credit cards. A famous slogan for Visa was, "It's everywhere you want to be." But some believe credit cards will take their business anywhere they want their company to be too. They are easy to get. The low teaser rates look very cheap compared to other rates. I worked at banks where we knew some financed their businesses with one or a series of cards. My caution is that multiple accounts, especially new accounts, can damage your personal credit score even if you make the required payments. This will make future debt more expensive. A personal loan source for a large amount of funds is a home loan. A first mortgage is when you get a loan secured by your house when you have no other existing debt on your house. First mortgages are often for fixed rates of 10 to 30 years. You can also get variable rate mortgages that are fixed for 3 to 10 years and then float annually after that with amortization terms of 15 to 30 years. Home equity loans could be a first mortgage or second mortgage. For example, if you already have a first mortgage on your house, you can take out a second mortgage if there's a big difference between the value of your house and the balance of your existing loan. Home equity loans are fixed rate loans with terms of 5 to 15 years. Home equity lines of credits are also known as HELOCs. Like fixed rate home loans, HELOCs can be first or second mortgages. They have a draw period of 5 to 10 years, during which they are a revolving line of credit. They then switch to a repayment period of 10 to 20 years. The loan rate and payment amount are fixed during the repayment period, so the balance at the start of the repayment period is paid evenly to zero by the end. They have a variable rate while they act like a revolving line. Remember that a revolving line is a loan that you can borrow from, pay off, and then borrow from again. You can keep borrowing on them as long as you haven't hit the maximum you can borrow on your line. Some business owners may prefer to use a HELOC to a business line of credit because you don't pay a commitment fee with a HELOC and the rate may be lower. Borrowing funds secured by your home may cause you to lose your home if you get into financial difficulty. Taking these loans for your business dreams could lead to a nightmare of losing your home. It's too big of a risk for some owners. For others, it's the only way to get desperately needed money. And for others, it's a smarter and cheaper source of financing than business loans.